Hi. Okay, so here we are in chapter 9. 9 of 12. We're 75% done. All right, so chapter 9 is going to talk about accounting for current liabilities and one of my all-time favorite topics, payroll. So first thing we need to understand, what do they mean, current liabilities? Well, current liabilities are going to be the opposite of what we talked about in chapter 7, the current receivables. Discussion of promissory notes. Remember that. So on September 1st, Herrera Supply Company, HSC, that's going to be our example. They borrowed $90,000 from the National Bank and they issued a note payable. The person or company that borrows the money is the issuer. The note had a 1-year term and a 9% interest rate. So the first thing we record is the cash we got. So we debit cash for $90,000. We credit notes payable. Note on the statement of cash flows, this is a financing activity. Next, we need to figure out the note started on September 1st. And on December 31st, at the end of the year, we have accrued interest expense that we have to recognize. So what do? We take that $90,000 principal times the 9% interest rate. That gives us $8,100. We divide that by 12 and multiply it by 4. Why 4? September, October, November, December. 4. So the accrued interest is going to be 4 times this number, or $2,700. So we debit interest expense to recognize the expense for the period, and we credit interest payable for $2,700 because the interest is going to get paid when the note matures. So now we're at maturity date, August 31st, year 2. The first thing we need to do is recognize the balance of the interest that's due. We recognized 4 months of interest last time, so we're going to recognize 8 months of interest now. Again, 90,000 times 0.09, divide that by 12, giving a monthly rate, and then multiply that times 8, gives us $5,400. So we debit interest expense for year 2, and we credit interest payable. So we now have the total interest of $8,100 in interest payable. Next is the entry to pay the interest. So we debit interest payable for $8,100, we credit cash. Note that on the statement of cash flows, the payment of interest is an operating activity, not a financing activity. So next we pay the principal. We're going to debit notes payable for $90,000, credit cash, and the note is taken care of. Now, sales tax. You're working on Champion Wave, so you've had some experience with sales tax. Most states require retail companies to collect sales tax on items sold to their customers. So the merchants are acting as an agent of the taxing agency, of the state. They're collecting the sales tax, and then they remit the tax to the state. In the state of California, the sales tax must be remitted to the state by the 15th of the following month. So January sales tax gets sent in by February 15th, February by March 15th, and so forth. Sales tax is a liability to the merchant. It is not revenue. Companies that use sales tax to pay their own bills are going to get into trouble. So her HSC sells merchandise to a customer for $2,000 cash plus tax in a state where the sales tax rate is 6%. So the first thing we need to do is figure out what's the sales tax. Well, it's $2,000 times 6% is $120. So we debit cash for $2,120. We credit sales tax payable for $120. And we credit sales revenue for the $2,000 for the merchandise. And obviously this went to create revenue, so this is an operating activity. on the statement of cash flows. When it's ready, time for the company to send the tax in, it's real simple. Debit sales tax payable, credit cash, and put it in an envelope and send it off to the state. In the case of California, send it off to Sacramento. Now, contingent liabilities. Contingent liabilities. The word contingent means that something is waiting for something else to happen. Contingent liabilities are things that a company may owe depending on something else happening. In most cases, contingent liabilities are court cases. So whether or not the company is going to owe anything is going to be dependent on whether or not they win or lose the case. So we have three possibilities here. If the liability is probable, so in other words, if we're probably going to lose the case, and estimable, we know how much we're going to have to pay, that has to be recognized in the financial statements as a liability. So it's going to come up on the balance sheet. If, on the other hand, there is a reasonable possibility we're going to lose the case, but there's no way of knowing how much we're going to have to pay, then that can't go on the books. But that's going to go into the notes to the financial statements. And as I've expressed before, there are times when the notes to the financial statements will tell us more than the financial statements themselves. And finally, if the loss of the case is remote, nothing to do. All right, so if I asked you, which I do to all of my classes, if I asked you if you bought anything in the last 6 months, if you read the warranty, your answer is probably no. Nobody reads the warranty. When do we read the warranty, though? Yeah, when something breaks or it stops working, right? We have to go find out, hey, how much of a warranty do I have here? Right, so a warranty typically is a promise by the company within a certain time frame to either repair or replace the product. There is a way that we have to record it from a financial accounting perspective, though. And the way we do that is this. HSC sold $7,000 for $7,000 cash merchandise that had cost $4,000. This is our standard merchandise sale, right? So the first thing we need to do is to recognize the revenue. So we debit cash, credit, sales revenue. The second thing we need to do is to recognize COGS. So we're debiting COGS for the $4,000 cost and credit merchandise inventory. Pretty straightforward stuff. Now this is where we get kind of like, if you remember the allowance for doubtful accounts in Chapter 7, right? HSC guaranteed the merchandise sold in Event 1 to be free from defects for 1 year. So we have a warranty here. And HSC has determined that if they have to fix something, it's probably going to cost around $100. So that's their liability of warranty. So we're going to debit warranty expense in the year in which we sold it for $100. And we're crediting warranties payable for $100. So we now have $100 in the warranty account that we can use in the event that we actually have to do a repair. And in this case, yeah, we did. HSC had to do a $40 cash repair for the merchandise. So we're debiting warranties payable and we're crediting cash. This topic is always a favorite of mine because payroll is something that I did for years as a professional. And I typically ask my students, how many of you can explain the stub on your paycheck? And nobody ever really knows. Only payroll and accounting people know this. So that's what we're going to find out here. Employers are required to withhold part of each employee's earnings to pay such items as income taxes, union dues, and medical insurance premiums. So besides the statutory deductions, these are other deductions. The employer is also required to make matching payments for certain items such as Social Security and to pay additional amounts. So we have the deductions from the employee's paycheck that have to be forwarded to either the federal or the state agencies or whoever it belongs to, because it doesn't belong to the company. And then the company also has to pay payroll expense taxes. That's what we're going to be talking about here. So as far as federal income taxes are concerned, assume an employee earns $2,000 and assume further the employee owes $300 of income tax on those earnings. On payday, the employer is going to debit salary expense for the gross pay, $2,000. Then they're going to credit employee income tax payable for $300, and we'll have a net check to cash for $1,700. When the employer pays the liability, both cash and liabilities will decrease. So when the company sends the income tax to the federal government, they're now going to debit employee income tax payable, credit cash, and send the check off. This is, you'll all be familiar, most of you are probably familiar with, if not all of you, a W-4. And W-4 changed a lot after President Trump's 2017 tax bill was passed in December of 2017. The W-4 became a very simple document. You can see step one, name, address of the employee. The important piece is this. Marital status has always been important with regards to calculating federal withholding. So that's what's going in there. Steps 2 through 4, only if they apply to you. And they apply to you if you have multiple jobs or if your spouse works. And then you're going to go on to 3 and 4, also have exceptions. This is the W-2 that we're all familiar with. How many people know when the W-2 must be received by the employee? Well, January 31st, that's the deadline. After that, they are in violation. And W-2 hasn't changed much over the years. We have the employer information here, the employee information down here, and then we've got all these numbered boxes. Box number 1, wages, tips, other compensation. So that's total gross pay. Box number 2, federal income tax withheld. So that was where the federal income tax that was deducted and forwarded to the federal government. Box number 3, Social Security wages. Box number 4, Social Security tax. Remember, Social Security is 6.2% of your pay. So that's what the tax is going to be. Now, it's interesting is box number 5 has Medicare wages and tips. Why would we have separate boxes for wages for Social Security and for Medicare? Well, that's because Social Security has a limit. And that limit has increased over the years because more and more people are living longer and collecting Social Security longer, and the government's running out of money. So this year, I believe in 2022, the limit for Social Security is 140. I'm thinking 147,000. I'm not sure. Let me go look it up. All right. Anyway, so what that means is that when you've earned $147,000, you have paid all of your Social Security tax for the year. That's why people with a six-figure income usually get pretty excited somewhere around August, September, because at that point, they've paid all their Social Security taxes, and from there to the end of the year, they get that extra 6.2%. It's kind of like getting a bonus. Now, Medicare is on every dollar you earn, from $1 to $infinity. So that's why we have two different boxes, because these could be two different numbers. Then we've got tips, allocated tips, state information. So the W-2 is pretty much a summary of what you got paid and what was paid for you with regards to the taxes. Congress adopted the FICA. FICA covers both Social Security and Medicare. Social Security is actually now called OASDI, Old Age, Survivor, and Disability Insurance, because it pays more than just people who've reached 65. And Medicare provides health insurance. Both of these are having serious funding issues, which would be interesting to go take a look at. We don't have time for it here. Not only employees are required to pay FICA taxes, the employer matches FICA. To ensure they make important payments, employees voluntarily allow their employer to withhold money. Now we have voluntary withholdings. Besides the statutory taxes that have to be taken out, there are going to be voluntary things. For example, medical insurance premiums. And with medical insurance costs going up, more and more employers are asking employees to make contributions to that. Union dues, charitable contributions, and contributions to retirement funds like 401k plans. Withholding voluntary deductions from an employee's gross earnings represents a service. So the employer is kind of doing you a favor. They're taking the money out of your check and then they're dispersing it to whoever's supposed to get it. The employer must deduct the amounts authorized by each employee. Remember, it has to be authorized or they can't take it. And remit the withheld money to the proper recipients. Again, this is a situation where the employer has to be honest and send the money out, not using it for their own benefit. Net pay, that's the bottom line, right? That's your gross earnings less all of your deductions, otherwise known as the take-home pay. So we have an example here. Sarah Jennings. Sarah makes $6,000 a month. Her federal withholding is $450. Her Social Security, now it says 6% for Social Security. Social Security is actually 6.2%. And Medicare is 1.45%. But they're using round numbers here. So $360 and $90. She's also having medical insurance premiums deducted. So she's making a $320 per paycheck contribution. Excuse me. And she's making a $25 contribution to the American Cancer Society. Her total deductions are $1,245. Her net pay, $4,755. Now, if this were a California paycheck, there would be a couple of other deductions here. One would be state withholding, right? State income tax. Another would be something called SDI. For those of you who've seen your paycheck and you've seen SDI, that stands for State Disability Insurance. It's a short-term disability insurance that you pay for that you can get from the state should you be injured and not be able to work. The journal entry to recognize salary expense for Ms. Jennings is as follows. So here we've got $6,000 debit to salary expense. That's the gross. Then we have all these payables, right? These are all the deductions that were made that need to be forwarded. So income tax payable, Social Security and Medicare payable, the medical insurance premiums, American Cancer Society, and then the last credit is to cash. That's the take-home pay, $4,755. And down here on the statement of cash flows, it is an operating activity. So then we've got employer payroll taxes. The employer has to match FICA, Social Security and Medicare, and the employer has to pay the unemployment taxes, FUTA and SUTA. So we've got the matching FICA here, $360 and $90 for Social Security and Medicare. Now FUTA is 6%. However, if the company is paying any state unemployment tax, the FUTA goes from 6% down to 0.6%. So in this case, and that's for the first $7,000. So this is $6, and state unemployment here is going to be 54. State unemployment rate is based on one big piece, the experience rating. That means how many employees do you have collecting? So if you work for a company that has a lot of turnover, in other words, hiring and firing employees, they probably have a very high unemployment tax rate. So here's the recording for the payroll taxes. We debit payroll tax expense for 510, and we credit Social Security and Medicare payable, the same accounts that we used for the employee. We have federal unemployment and tax payable, SUTA payable. And since there's no cash here, there's no statement of cash flow effect. And these are fringe benefits. So fringe benefits are things above and beyond your gross. In this case, Alice Worthington accrues $200 a month in vacation pay. HSC pays $250 a month for her medical insurance, and they contribute $150 to a pension plan. So we see down here, we have vacation pay expense, medical insurance expense, and pension expense. Those are the debits. The credits go to payable accounts. We've got vacation pay payable, which is going to be debited when she takes vacation. Employee medical insurance payable, which will be debited when the company pays their premium at the end of the month. And employee pension liability, which funds the employee's pension plan. What we're looking at here is a classified balance sheet. A classified means that we're going to take assets and liabilities and we're going to break them down into short-term and long-term. So a current asset is expected to be converted to cash or consumed within 1 year or an operating cycle. And here are the current assets: cash, marketable securities, accounts receivable, short-term notes receivable. All of these are current. They're going to happen within a year. And notice something else too. They're listed by order of liquidity. How easy is it to turn them into cash? For the liabilities, current liabilities, things like accounts payable, short-term notes payable, wages payable, taxes payable, interest payable. So we look at our balance sheet, and our classified balance sheet has current assets. Now, who remembers what this is called? There's a term for this. If you don't remember, it's called the book value of the asset. Remember, cost minus accumulated depreciation is book value. So we have a book value of office equipment of $55,000, a book value of the building of $300. Land gets neither depreciated, depleted, nor amortized, so it's at $120. That's what we paid for it. So here's total plant and equipment. That's long-term assets. Here's our total assets. Then we go over to liabilities and stockholders' equity. Here are our current liabilities, $193.8. We have one long-term liability, notes payable, for $100,000. So our total liabilities are $293.8. Note that if you have a mortgage at the beginning of the year, you're going to figure out what amount of that mortgage has to be paid in this year, and that will become mortgage payable under current liabilities. The balance will stay under long-term. The last thing we're going to talk about is liquidity versus solvency. Liquidity means, can you pay your bills? Solvency means, can you stay in business? The difference being, in terms of liquidity, if I go and borrow $1,000 to pay my bills at the end of the month because I don't have $1,000, that's liquidity problem. If that $1,000, if I need to get that every single month, that becomes a solvency problem because I'm never going to be able to keep it going. So measuring liquidity, typically companies will use the current ratio. You're going to see that a lot. Current ratio compares current assets to current liabilities. Current ratio is among the most widely used ratios in analyzing financial statements. So if you think of it this way, if your current assets are $10 and your current liabilities are $10, your current ratio is 1. If your current assets are $5 and your current liabilities are $10, your current ratio is 1/2. And if your current assets are 20 and your current liabilities are 10, your current ratio is 2. So what that shows is The minimum current ratio you want is 1, where your assets equal your liabilities. But it's nice to have more than 1. In the companies that I worked for over my career, I worked in professional services, so the current ratio was a little higher than typical. The current ratio ran between 4 and 5. And that takes care of Chapter 9. Please let me know if I can help you in any way, and I will see you around class.